Okay, so yes, so we'll start the webinar. Hi everyone, welcome. Thanks for joining in on a Saturday evening, right? I and Anshul are already here. We'll be also joined by Bhupi and Vivek from InCred team later, right? So today we are obviously going to discuss about the upcoming issue, InCred Jan'22, right? The senior secured bond issue. It will be going live on Monday, right? So before we get into the details, let's look at what we do at Windwell just as a recap, right? So our core investment policy is very simple. Bring secure assets, right, backed by loan receivables such as home loans, gold loans, personal loan. So many folks would know this is the first time we are bringing asset where the underlying loans are unsecured, either personal loans, right, or unsecured loans, right. So do understand, like we will discuss the specific risk here in the webinar, right? Anshul will take us through, right? But yeah, all these assets are secured, even though underlying loans are unsecured, there is still some loans that are kept as collateral. So these are secured bonds, right? So, senior secured bonds to be specific. Our core investment policy, another factor of it is fixed return assets, right? Most of these assets are not related to market, right? So if the market crashes, your money is still compounding in the fixed return pattern, right? And third, I mean, we only work with very well-run NBFCs or housing finance companies, right? Housing finance companies are like a special type of NBFCs only, right? Non-banking financial companies. And the criteria is low leverage, great external equity investors, and good corporate governance, right? So all the assets will follow this core investment policy on Windwell, right? So let's go to the next slide, right? Again, just a summary, right? There are different terminologies in the market, and many of the investors may not be clear with what kind of bonds they are investing in, right? So there are three major bonds categories you can see. One, first it's senior secured bond, then senior unsecured bonds, right? And then subordinated bonds, right? So senior secured bonds are secured by collateral. So there is underlying loans portfolio that is there. There is some collateral. In case of unsecured, there is no collateral. So if the entity defaults, right, the recovery is bit difficult, right? And the most risky ones are subordinated bond. In terms of risk, subordinated bonds are most risky, then senior unsecured, and senior secured bonds are safer. They are kind of medium to high risk, right? So obviously returns will collaborate with that, right? So again, these senior secured bonds are not exact replacement for FDs, are not replacement for FDs. They come with certain risk. We mitigate that risk, but that risk is not zero, right? So again, and the third is if the NBFC goes bankrupt, these are the priorities, right? Senior secured bond have the first priority. Then if there is any capital, then the money flows to senior unsecured. And if at all there is any collateral, any money left, then it flows to subordinated bonds, right? And these risk profiles are compared to each other, and these are not these asset classes are not per se comparable to, like, or we have not compared it to equities or etc other asset classes, right? So hope that is clear. If there are any questions, feel free to ask into Q&A. We will cover all the questions, right? Let's go to the next slide, right? Why Windwell? Like obviously I'm just talking good things about Windwell. Very proud of what we are building here, but idea is to we want to develop this one platform for debt investments for retail investors. What is very core at the basic is we want to make it available for retail investors and not like ultra rich people or institutional investors. That has been our commitment from day one, right? We have had hard times doing it, but we are still very committed to it, and we'll keep delivering on the same, right? Second is we want to educate investors about the risk structure of this asset class, especially when you talk about investment products. Risk is part of the product. It cannot be something that is at the in some footnote or something that is run at a 2x speed, right? These are simple, smooth flow, and obviously product will be simple and smooth for you to invest. And then consolidate, you can on the dashboard you can see all the investments that you have done on the platform, right? Access, obviously we talked about it. And third, we are 100% transparent, right? We don't want to sell products. We just want to talk about the risk involved, the transparency, and let retail investor make the choice, right? So these has been our core tenets, and that's what we have been working, right? We have about now 75,000 signups, over 11,000 investors, 150 crore invested through the platform. And the next one is our biggest asset, right? 125 crore with a 25 crore additional, like the NBFC can, if money is raised, they can again raise up to 150 crores. So the EM should grow very significantly from here, right? And many more assets are coming. So thanks for your support. And now we will get into the details. First, we'll talk about the NBFC, then underlying portfolio, right? And then we will also at the end visit how to invest, and then we'll start question answers. So over to you, Anshul.
Thanks, Ajinkya. Now coming to the NBFC and the issue that is going live on Monday. The issuer for this transaction is NBFC called as InCred. InCred is into multiple business segments. The top three are personal loans, education loans, and SME loans. To give us some context and background about InCred, it was started way back in 2017. The net worth of the entity has crossed 1,000 CR, and the portfolio size is roughly 3,000 CR as on September. The NPAs of the entity, the non-performing assets, has been below 4%, and net NPA, which is net of provisioning, the number is less than 2%. It's backed by very marquee equity investors, which is also one of our core investment policy. The equity backers include names like InvestCorp, Moore Strategic Ventures, Elevar, and VOcean. Now coming to the liabilities of InCred, there are more than 25 existing lenders on their balance sheet. This includes institutions like State Bank of India, Bank of Baroda, Tata Capital, Aditya Birla Group, foreign funds like Responsibility, small finance banks like Suryodaya, and so on. So I would say a diversified lender base coming from banks, funds, small finance banks, and so on. The key financial parameters of the entity are summarized here. The entity has been profit making despite growing at a pace of roughly 30% year on year. Entity did a significant equity raise in FY20, because of which the net worth or the equity base of the entity almost doubled from 600 CR to slightly above 1,000 CR. Good thing about the entity has maintained a low leverage. NBFCs in India are technically allowed to take debt up to more than 6 times their equity. And most of the NBFCs in the market like to operate at a leverage of around 3.5 to 4x. InCred, on the other hand, has consistently kept the leverage less than 2.5x for past 3-4 years. The NPAs have increased slightly over the past year, mostly due to COVID, but still has been much better compared to the industry standards, compared to other entities operating in similar space. Entity has geographical presence in 9 states, including states of Maharashtra, Delhi, Tamil Nadu, Telangana, Andhra, Bengal, Gujarat, Karnataka, and Rajasthan. The entity was founded by Mr. Bhupinder Singh. Bhupinder Singh and Vivek Bansal will also join us in the webinar shortly, wherein they will discuss about how they started the company, how the underwriting is done, how the various business segments are performing. Before starting InCred, Bhupinder Singh was head of corporate finance division of Deutsche Bank, and he was co-heading the fixed income equities and IBD division for the Asia Pacific region. Coming to the issue, the minimum ticket size for the issue has been kept as 10,000. It's a public issue which will be listed on both NSE and BSE. This issue is slightly different from our earlier issuances. In our earlier issuances, there used to be just one series of NCDs which used to get issued, which means there was just a single choice for the investor in terms of tenor, yield, etc. Everything was fixed. While in this transaction, there are three choices available to the investors. The three CDs have different tenor profile and hence different yield profile. So depending upon the risk return appetite of the investor, for how much time they want to remain invested, the investor can make the choice and invest in either one or more than one of the three CDs. The returns, as we'll study in the latest slide for the three CDs, and the issue is rated as A by CRISIL. The issue has also been kept under watch with positive implications, which denotes that potentially in future the issue might get upgraded also. Coming to the some of the salient features of the issue, the bond size, the bond is backed by a security pool of a mix of secured and unsecured loans. The total size of the underlying security or collateral backing the bond is 1.2 times, which means if including the green shoe, the bond issued are worth 150 crores, the underlying collateral pool will comprise of loans worth at least 180 CR. Like I said, there are multiple CDs in the issue, and depending on the risk appetite, investors can choose the CDs. In case if any loan in the underlying pool were to become delinquent, NPA, entity will replace that NPA loan with a performing loan. And lastly, the underlying pool is a mix of secured loans and unsecured loans. Secured loans can be property loans or loans backed by FLDG, while unsecured loans will be mostly student loans and personal loans. Coming to the risks in the transaction, primarily like any other bond, there are three risks for the investors, which everyone should be aware of. First is the liquidity risk. These are not, even though they are listed on the exchange, these are not very liquid instruments. So invest only that much amount which you are comfortable holding till maturity. In case any investor wants to exit before the maturity of the instrument, they can reach out to us. We in turn can reach out to other investors on the platform and see if there is a willing buyer. And in normal cases, we do find willing buyers, but in extreme scenarios, there is a hypothetical scenario that such willing buyer may not be available. So don't treat these as liquid securities and invest only that much amount which you are comfortable holding till maturity. Second is the credit risk. These are not risk-free instruments, so definitely not a replacement for FDs. One should not be parking the emergency funds in these instruments. Understand the risk. Once you're comfortable and appreciate the underlying credit risk in the instrument, then only go for the investment. Third is a fraud risk. It's there in any financial instrument, like you said. What if the data of the underlying pool, etc., is fake? There is some fraud there. We try to mitigate all these risks, but some level of risk always remains in the transaction. Now, coming to the three series or three choices which investors have in this transaction, there are three series of NCDs which are being issued. Series 1 has a tenor of 1 year and offers 9.25% XIRR returns. The interest and principal will be paid at the end of 1 year. Series 2 is a 2-year NCD with annual interest repayment and principal being paid in one shot at the end of 2 years. The returns in this series is 9.65%. And lastly is a series, it's an amortizing series in which even though tenor is 2 years, 50% of the principal will be repaid at the end of year 1 and balance 50% will be repaid at the end of second year. The interest in series 2 and series 3 will be paid annually. And the yield of series 3, the coupon of series 3 is 9.52% XIRR. It's a pictorial representation of how the repayments will flow. Like I said, in series 1, it's a 1-year tranche. Whatever amount principal you invest, you will get back at the end of 1 year, along with 9.25% returns. In series 2, the principal will come back in one shot at the end of 2 years. At the end of year 1, you will get your first tranche of coupon repayment, which will be 9.65% XARR. And at the end of year 2, you will get the second coupon repayment along with the principal. Series 3 is a amortizing tranche. By amortizing, I mean 50% of the principal will be repaid at the end of year 1 along with the first year's coupon, and balance 50% principal will be repaid at the end of second year along with the coupon of the second year. The yield for this series is 9.52% XARR. Now I'll ask Ajinkya just to give a quick demonstration how our investors can invest in this issue.
Sure. I'll share my screen. Give me a moment. Yes. So once you log in, once you read all the disclosures, you will see this screen, right? And these series, this is just a demo. So these are not actual numbers, right? These are not actual series, neither the maturity period nor the effective yield. This is only for the demonstration purpose, right? So there are 3 series in this bond, right? So let's say you choose this series, right? You select how many units you want to invest, right? Then you go to the next step. Here you will need to put some your mobile number, right? Your email ID. Let's say I'm just putting just demo email IDs and everything. So there's not a right. So you will put all these details. So PAN, name as per PAN card, your email ID, your mobile number, and your 16-digit DMAT ID. If you don't know your email ID, you will find it in your broker account in your console. You can click here and know more. If there are still questions, you can ping our education team and they will answer. So I'm just trying. So it is a 16-digit DMAT ID that you'll have to enter, right? And then you confirm all these details, right? So this flow, then it will ask for your UPI ID. So I'm going to put a demo UPI ID, right? This is similarly how you apply to equity IPO, right? Then you submit this application, right? And then you will get a mandate of the same thing on your UPI app. It sometimes, if there is some delay, generally there is not, but if there is delay, you will get it after some time, like within 24 hours, right? And then you have to accept this mandate and complete the payment within 48 hours once you get it, right? Once you accept this, this all mandates go to BSE for application. This is like how equity IPO works, right? The similar mandate you will sign, right? And once the issue is listed, right? Once the asset is fully subscribed, you will receive the bonds in your DMAT account, right? In 4 steps. So this is pretty easy. The critical part here is to know your DMAT ID, right? So make sure you know your DMAT ID beforehand, right? And if you have any questions around that, how to find DMAT ID, we have put in some videos on YouTube channel. If you're not sure, just message on our WhatsApp. Our website homepage has a WhatsApp button through which you can directly get in touch with our education team and ask questions, right? So it is pretty easy. All you need is UPI ID and DMAT ID, right? PAN number, everybody knows, I'm assuming, right? So this is broadly how you will invest, right? Now I think we have Bhupinder and Vivek from InCred team. So we received some questions and we had this feedback from a lot of people that we want to meet the management team of the Nbfc we are investing in. So we have received a bunch of questions, right? I'm going to ask them the same questions, right? Vivek, can you hear me? Can you switch on your camera and audio? And
yes, can hear you very well.
Yes.
Hi guys, can you hear me?
Yes. Yes, Bhupinder is here. Hey, hi Bhupinder. Good evening. Good evening, Vivek. So we'll start with a simple question. A lot of people had this. We saw this question. How and why did you start? InCred. What was the inspiration? What was the problem you are set out to solve? And how's the journey been so far?
Sure. Firstly, thank you so much for inviting us for this call. बहुत अच्छा मौका मिला है मुझे और विवेक को to address the Wint Wealth customers. Real pleasure to be here. So InCred was started back in 2016. I had personally several years in global banking in London and Singapore. I was managing Deutsche Bank's Asia business until 2016, and felt it was time to move back to India with the phenomenal opportunity in Indian financial services. And it's then in 2016 I'd also turned 40, as they say, 40-year itch hoti hai, entrepreneurial itch. So that bug clearly bit me as well. And took the plunge into entrepreneurship by setting up InCred. To your question on the opportunity set and the problem we were looking to solve, look, there is a tremendous gap in availability of credit and the demand for credit. There are large sections of retail customers, small businesses across India that are being underserved by traditional Indian financial services, and that's the segment we have gone after at InCred. Thank you.
Understood. Yes. So, Bhupi, the next set of questions are particularly around why do you choose to get in some of the loans and not like why do you choose to do personal loans and education loans, right? And what is the logic? Because there is a lot of competition. How do you find the competition from banks, right? So, would love to know and this is the first time, in fact, we are underwriting a bond where underlying portfolio is unsecured loans, right? Till now, here obviously only 50% is unsecured, 50% is secured. Till now, we have done 100% collateral backed loans. This is the first time we are doing. So there were a lot of questions around why personal loans, why education loans.
Sure.
How do you look at it, unsecured loans to secured loans?
Okay. So I'll take the question on personal loans first. I think personal loan space may once again large segments have traditionally been underserved by financial institutions, and while big picture what you say about the competition is true, that there are now several banks, Nbfcs, fintechs in the space, the opportunity set is so vast that frankly the competitive element is not the relevant element with respect to the key ingredients to success. If you ask me to list out, if you ask me ki top 10 success factors kya honge personal loans mein, frankly, the competitive environment would not even make it to my list of 10. It's all about your own risk processes, risk discipline, your analytics, your technology that powers the risk engine. It's all of those things that determine success. We see enough and more opportunity in the personal loan segment to deploy capital in a very prudent manner at very good returns and very manageable risk. On your other question on education, look, we only provide loans to schools that are already functioning successfully. We have a criteria that schools have to have at least 3 to 4 years of class 10 results history. And we provide loans to facilitate their expansion. We're not helping schools set up new curriculums, new buildings. We're providing loans for the expansion of existing schools that have been in business for many, many years. We make a lending assessment, therefore, on the basis of existing cash flows, for example, through fees. And in addition, we ensure that we protect ourselves by taking charge over the school property. We have the right to change trustees of the school. We take personal guarantees of the trustees of the school, and in some cases, even take personal properties of the trustees.
Understood.
Thank you, and back to you.
Yeah. So, Bhupi, one more question here is like, how do you look at unsecured loans and secured loans? Because I mean, obviously, with your experience, you would have a lot of insights. But from someone outsider, unsecured loans seem very risky compared to a secured loan, because whatever happens if property is there, right?
Yeah.
How do you look at unsecured loans, especially? How risky are they really?
So I'd say two things. One, the approach to managing unsecured loans and secured loans is very distinct, very different. Usko टॉप डाउन अगर आप देखें तो हम इंटरनली 2 डिफरेंट वेज में इसको डिस्क्राइब करते हैं. इन सिक्योर्ड लोन्स हम लोग इसको बोलते हैं डोमेन नॉलेज लेड अंडरराइटिंग. सो व्हाट दैट मीन्स इज कि कोई भी सेगमेंट हो, जैसे स्कूल्स है, the people we have who take the decisions on whether to lend to a school or not are all people who have years and decades of experience in that particular segment. उनको पता होगा कि उस स्कूल के आसपास कितने नए स्कूल आ रहे हैं, what could be the impact on this school that we're lending to, with respect to intake of new students, with respect to pressure on fees, etc. So deep domain knowledge. We spend months and quarters assessing a particular segment before we decide to go into it. And all the segments we are in, we have deep expertise and domain knowledge, and we typically hire people who've been doing the same business for years and decades in most cases. Unsecured loan, जो personal loans है, उसमें बड़ी different approach है. This approach of having people doesn't work there. It's a scale business. So risk analytics and technology plays a very, very, very big role in the unsecured business. And our underwriting process in unsecured loans has shown best-in-class results over multiple cycles in the Indian market. We've been through COVID. Before that, we went through the ILFS crisis. Uske pehle demonetization tha. And that's in the last 5 years. And Bajaj Finance has been through many more cycles over their 15-year journey. And our lending process, which once again I'll reiterate, is based on risk analytics in consumer loans, is continuously calibrated. It's a process where we are on a consistent basis, continuously learning from everything we do. And it creates, usko hum bolte hain, virtuous feedback loop. Every day we learn something new. It gets fed back into our machine learning and AI models, and it just keeps improving the algorithmic underwriting process on a day-by-day basis. And our performance through these cycles has been as good as any risk metrics that is in the industry.
Understood. This is very helpful. In fact, I remember when I was at Credit Vidya, InCred was pretty new. And I distinctly remember like InCred having a lot of focus on using technology and leveraging technology. So yeah, now it makes sense, right? Then there are a bunch of questions for Vivek. So Vivek, one of the key question here is, why did you close your two-wheeler loan business? Vivek, you're on mute.
As Bhupi was alluding to, that in terms of businesses, we have formed a core philosophy that we need to have a right to play in each of the businesses we operate in, either through use of technology or through deep domain knowledge expertise, right? So some of the businesses Bhupi was alluding towards student loans, schools, where it is about deep domain knowledge expertise. Personal loan, we have created a right to play and a differentiation through use of technology, the virtuous loop which Bhupi was talking about. As we moved forward in our cycle, we realized that two-wheeler, the nature of business and the underwriting is very similar to personal loan. But if you look at the operating cost, which we have to incur in a two-wheeler business, is much higher than a personal loan. So given that the nature of the business and nature of underwriting is very similar, the customer set is very similar, the yield minus risk dynamics minus operating cost dynamics were much better for us in PL business. And we thought that it is better to scale in some businesses rather than have subscale businesses. In a subscale business, you end up having losses in that business. So that's the reason we actually exited two-wheeler and double down on how we will do underwriting in our personal loan business, given the edge which we had created through use of our technology and AI/ML model.
Understood. Makes sense. Vivek, another question for you is how is the COVID impact on the business? What percentage of the portfolio was restructured? How is the restructuring performance? You are looking at how are you looking at the portfolio of the restructured portfolio? And with COVID waves coming anytime, how do you look at mitigating that risk?
No, very, very good question, Ajinkya. And I think this is a question which most people would be interested in, to understand how we have weathered this COVID pandemic and how we have come out of this. So I'll cover this in all the parts. Like when wave 1 hit us, there was a moratorium which was granted by government, wherein we compulsory had to give moratorium to customers. One noteworthy thing here is that we never took any moratorium from any of our lenders. So that means despite giving moratorium to customers, and we gave moratorium to about 50% of our customers at the peak of moratorium, and we didn't take moratorium from any of our lenders. That 50% actually gradually came down, and you'll be happy to note that our collection efficiency currently is actually at pre-pandemic levels or better than that. So what it signifies are 2-3 things. One is obviously the investments which we made in our collections team have really borne fruit. The personal loan business, the use of technology, I am kind of again emphasizing that, but that has been a very big contributor in why we have been able to collect and maintain the collection efficiencies which we have been, because we do have a geo tagging and location access of an individual. So it becomes far easier for our collection guys to go and collect the money from customers. In terms of how the portfolios are doing, I think extremely well. There has been obviously some impact on credit costs, but if you compare us with peers, our credit card increase is significantly lesser than what you have seen on street. Our actual numbers, we would end this year by March 2000. What the number as of today is between 2 to 2.5% credit cost. Our gross NPAs are 3.9%, net NPAs are 1.9. Now compare that with any other player. I mean, if you have to make a comparison, and this is like unsecured, secured, all the businesses together, right? So right reflection that only effectively 1.9% is unprovided, right? And that means that even if someone looks what is a capital at risk, it is just 1.9%, right? So if we have 100 rupee capital, so we are currently capitalized by about 1100 crore, only 1.9% of that is not provided for in terms of NPA. Rest everything is provided for. And mind you that whatever account turns NPA, it is not that it is 100% lost. Yes. We do recover a large part of that. In secured, obviously, a near large part, and in unsecured also a reasonable sum.
How much would be that in unsecured? 40%, 30%, 50%?
On the provisioning?
Yes.
On unsecured, we provide 65% for our 90 plus books, and on secured, we provide 50%.
Understood. No, I mean, my question was how much of that actually ends up getting recovered?
So it's you can safely assume that 65% is what we are providing. So based on the track record of what we have been doing, auditors actually look at that while approving the provisioning ratio under the Ind AS framework. So the recovery would be closer to the unprovided part.
Understood. Okay, this is very helpful. So Bhupi, back to you. You mentioned technology. So one question is related to that. You mentioned that you have digital partners like Early Salaries, Dashpin. What are these kind of partnership, and how do you look at them in a broader strategy of the business?
Sure. Look, these are entities we use to originate loans for us, which are then run through our rigorous InCred's in-house underwriting process, our risk analytics process, much the same way that we run any other origination channel through. So in other words, the way we build technology in risk analytics is I use the word agnostic. It's agnostic to where the business is being originated, whether it's our own digital platform, LinkedIn ads, Facebook ads, Google ads, channel partners, or the names that you mentioned. In all cases, we have the same engine that's powering our risk analytics that every trade has to go through, that rigorous process, right? The beauty of working with these entities is many of these have received very large equity inflows, given the valuation in the tech world. So a lot of them aren't in a hurry to make money. And that's great for us. We're able to source loans for us in a very cost-effective manner when we work with these entities. But there's no strategic angle beyond that.
Yeah. Okay. That's I can definitely relate to that. Now on the other side, you have players like Windwell who can help you raise liabilities with low costs. So Bhupi, the next question is like, how do you look at the business in future? You're at about 3,000 crore book size, right? How do you look at it in the next 3 to 5 years? How will this business look like? How much will be the equity, right?
Sure. So first thing I'll say, and I'll reiterate, is what will continue to drive business growth for us is that focus on risk that I talked about, and every element of risk, from how we engage with customers, which itself feeds into ultimate risk numbers, our fraud analytics once the customer's login is done, and then of course our core engine, which is the credit underwriting engine. And then the stuff Vivek talked about, which is the collections part and the backend part. That entire value chain of a lending product journey is for us powered with a risk-first approach. Unlike the way it's done at many of the competitors that we face off against. And the reason I will continue to stick to that approach is a point I raised earlier, which is growth is available aplenty in a country like ours, which is growing at 6 to 7%, 5 in a bad year, 7, 8, 8, 9 in a good year. On the GDP front, you then apply a 1.5 type multiple with respect to credit growth, you get into double-digit numbers. And then with 50+% of that sitting with public sector banks, which aren't growing nearly as fast in consumer lending, the opportunity for small players like us with respect to growth is 30, 40, 50%, right? So growth is not the challenge. So we will continue to be prudent on risk practices, and the entire ethos of the firm will continue to be built around risk. And yet we think we can comfortably deliver 30, 35% growth with sensible risk numbers.
Understood. So yeah, in fact, I remember this, one of my mentors had told me, in lending, it's very easy to give money. If you give me 1,000 crores, I can disburse that in a day. But उसमें से कितना वापस आएगा वो नहीं पता. So that prudentness is like I can totally relate to it. One last question, Bhupi, is like InCred is now merging with KKR India Financial Services. So can you shed some more light on that, and how will that benefit InCred?
Sure. So we're going through that merger process with KKR India Financial Services as we speak. It's the Nbfc arm of KKR in India. Look, the merger will provide a significant equity injection for InCred Finance. You talked about the equity numbers in your previous question. Sorry, I didn't address that because this process is still underway. But expect our equity to roughly double. Vivek's given you the current net worth numbers. We expect to double from that already very high net worth number of 1,000 crores plus with this transaction. In addition, we'll get marquee shareholders like KKR, the Texas Teachers Retirement Pension, ADIA, Abu Dhabi Investment Authority. All of these investors will be joining our equity roster. We get reported in the press a lot for a mid-sized company, and you'll observe our shareholder roster, our management team is held in very high regard already. But I think the additions of the names I mentioned will take us to the next level now. And this injection of capital will enable us to continue to serve our retail, our small business customers even better, and provide even more cushion and buffer to all our debt providers, including those on the call today.
Understood. Yeah, makes complete sense. We are pretty excited about that as a lender also. So yeah, so those are the main questions. Thank you so much for joining in and answering.
Thank you. Thank you for having us over. It was a real pleasure. Great questions, and look forward to the successful conclusion of the transaction.
Yep. Thank you. For everyone else here, if you have any specific questions for Bhupinder and Vivek, please send us through. We will get them answered after the webinar or sometime, if not on live. So now we will move into the question answer session that are asked. Thank you, Bhupi. Thank you, Vivek.
Okay, we'll leave the call. Thank you very much. Thank you, everyone. Bye. Thanks for your time.
Bye.
Yes. So we'll start the question. So some of the questions are already answered by the team, right? So if your question is answered and you're still not satisfied, let us know. Before we start with the question and answer, I forgot to talk about two things which are very important, like how much to invest and what are the risk involved. Again, let us understand practically what are the risk involved, right? First is your liquidity risk, right? So if there are two kinds of liquidity risk. If the Nbfc goes bankrupt, right, then you have to wait till moratorium process is over. And we will talk about some of the examples, how that process takes time, right? And so your money would be stuck. That is one risk, right? Second is, if let's say this has a maturity of 2 years, you have invested in a 2-year series, you want to get out after 1 year, then there has to be a buyer, because Nbfc is only going to pay after 2 years, right? So for that, like we obviously help you find out the buyer. As soon as the asset is over, there is a huge wait list, right? So people want to invest in those assets, but that liquidity is not guaranteed. So don't park your emergency fund here. Don't treat this as emergency fund, and only invest that much amount that you can hold till maturity, right? Only invest with a mindset of holding till maturity. So that's how liquidity risk can be mitigated, right? Second is credit risk, right? In my opinion, credit risk is low, right? Because there is so much over collateralization, we have underwritten the NBFC well. Credit risk is basically risk of actually losing money is low, right? And Anshul talked about those features of the bond or triggers clauses in the bond to make sure that the money is not put on risk, right? Third is which is always a bigger risk in entities, is the fraud risk, and especially the promoter fraud risk, right? If you have seen ILFS and DHFL AAA rated entities going bust, those were mainly because of promoter or management fraud, right? How we mitigate that risk is by making sure these entities are lowly leveraged, right? So that they have, and when the leverage is low, so again, I'll give a perspective, right? So if the leverage is 1, that means out of 100 rupees, 50 is debt, 50 is equity, right? So when the business has so much equity in the business compared to the loan book, they don't actually need to resort to malpractices, etc. That starts happening when the leverage is used. So low leverage, good set of equity investors, we vet the promoter background also, right? So that's how we mitigate the fraud risk, but the risk is still not zero. So when I said these are high risk, but risks are mitigated, these are the 3 risks I was talking about. We talk about that often, but just want to reiterate: liquidity risk, fraud risk, and credit risk, right? So understand this risk completely. If you're not sure, you can go through our videos, or you can ping our education team, get on a call and understand this better. Second, I saw one question was, should we invest retirement money here, and should we invest 10% of the portfolio? The answer is complete no, right? You have to diversify while you invest. We have been telling this to all the people, and ideally you should be investing at least on 10 assets on the Wint platform, and you should not be allocating more than 10% of the portfolio to this asset class, these bonds as such, right? We will bring out more asset classes there you and we will tell how we invest, and these all kind of thumb rules come from our own investment, how we invest, right? As person, I mean, I've talked about it in previous webinars. The whole idea of starting Windwell was to make these products accessible for people like myself, right? So don't invest more than 10%, and invest that in 10 bonds, right? And there are a lot of bonds that are coming up, right? So just because you don't get allocation in some of the bonds, don't over invest. That's a very risky and very wrong strategy, right? You should increase the exposure slowly once you understand the asset class. It is very important. Investment is a long game. This is not a one-day return that you're looking for, right? This is a long game. So start slow, start small, diversify well, and then grow. Hope this question is answered, right? So 2 things, always remember: understand the risk, we talked about them, and invest prudently, diversify well. Diversify is very important. If you're investing on Windwell's one asset, only invest if you're going to invest in 10 assets. Slowly. I'm not saying invest like immediately whenever you build comfort, go slowly. If you're not sure, invest low. Understand these assets, understand how they perform, and then start investing more and more, right? These are very long-term assets. I mean, the tenure might be small, but we are bringing more assets. As these assets get over in the tenure, we will bring out another asset from the same Nbfc, right? So make sure that you invest slowly, you don't go over aggressive unnecessary, and basic one word, always remember: diversify well, right? So with that, we'll start taking questions, right? I see 68 questions are already answered. 6 are probably repeat, therefore we have dismissed them, right? Or these are irrelevant, right? So, and there are 51 open questions. We'll take these questions, right? In the answered question, if your question is still not answered, just mention that this question is answered, but I'm not satisfied. Please answer this again, and we'll take it up, right? So we'll start this with question, right? First, we are going to, so there are 2 set of questions. First are asset related questions, and then second are broader Wint wealth related questions, and third are economy related questions. I see how's the market in etc, right? So we'll first take the asset related questions, because that's what we are here for. But be assured that regardless of that, we will take all the questions, right? So Can you compare InCred's NPA statistics, gross and net, with other similar NBFCs? Is 3.4% gross NPA good or bad? How to understand that without a comparison with other NBFCs in the same or similar lending space? Anshul, can you answer this?
Sure. So if we compare 3 to 4% NPA that InCred has demonstrated during the COVID year with some of the other entities in, I'll say, similar segments, the answer would be like InCred's performance has been at par or better than the industry on average. Because especially in the PL segment, personal loan segment, we have seen very high NPA numbers that entities have reported. So some of the peers in PL segment can be someone, let's say, Navi, Finserv, or Bajaj Finance, Fullerton. These are some of the other NBFCs, or someone like Early Salary, Crazy Bee, etc. All these entities have some kind of portfolio allocation in the PL segment. And InCred numbers have been either at par or slightly better compared to some of these NBFCs.
Understood. Anshul, this is a very interesting question. Why one day added to 1 year series?
So it's happening because of some technical regulation. If the tenor of the instrument is 1 year or lower, the face value of such instruments needs to be 5 lakh. It's coming because of RBI's money market guidelines. So any instrument which has tenor less than 1 year, the face value needs to be 5 lakh. And since at Wint we want to democratize this asset class, because of that, we unfortunately cannot bring instruments where tenor is less than a year.
Understood. So, and Anshul, one more question: is the NPA very different from secured or unsecured loan? Any statistics on this industry wide? And how do you look at it? Gross and net both.
Right. At an industry level, performance of PL segment has been slightly worse, slightly bad compared to secured asset classes like vehicle finance, property loans, etc. Both at a gross NPA level and at a net NPA level. And the same is true for ultimate credit cost also. So yes, that statement is factually true. PL as a segment has performed slightly worse compared to secured asset classes.
Understood. In spite of having collateral and highly secured, it still has only A rating. Why not AAA?
It's a good question, and I'll just take 2 minutes to explain like how rating models in India are developed, configured, etc. So when rating agencies in India assign a rating, they only assign a rating basis probability of default, and they don't care that much about loss given default. So these are two different terms. Probability of default means कि default होगा या नहीं होगा, and loss given default indicates कि tomorrow if a loss happens, what will be my recovery? So when we say the bond is secured by 1.2x times, that has no bearing in a rating agency model because they are rating probability of default. So tomorrow if InCred were to do a unsecured bond, which means there is zero collateral, you are only taking InCred's word at face value. Even that unsecured bond will get a CRISIL A rating because rating agencies are rating probability of default and not loss given default. So how secure, how large the collateral is has no bearing on the rating of the issue.
Understood. The coverage ratio of 1.2x looks much lower to previous issues at Wint, especially that this issue has unsecured loans in the pool. Any reasons for this lower coverage?
Right. So at Wint, we have been communicating this that coverage will be at least 1.1 times. Anything above than 1.1 is kind of a bonus for us. If you look at the NPA numbers of the entity with the collateral that we have taken, it's still more than 5x. The gross NPA has been slightly below 4%. NPA doesn't mean everything that becomes NPA will be written off. Let's say the credit cost is 75% of NPA. So the credit cost, let's say, is 3%. if you look at the over collateralization, the extra cushion that we have kept, it's still 6 times or 7 times that figure. So, which is still good as per our estimate.
Understood. And the thing is that as soon as any loan become NP, it will be replaced with a healthy loan, right? Always.
Yes, yes. So all those criteria are over and above this. In case if any loan becomes 90 plus delinquent, NPA means a loan has skipped 3 EMIs, entity will anyways replace that loan with a performing loan. And there are other criteria also in terms of what percentage of the overall pool can consist of, let's say, even a 1 EMI delinquent loan. So there are other criteria over and above this.
Understood. Yes. What if the NBFC defaults? How much money will I be able to get back with their underlying assets?
See, it's like difficult to quantify. If such a scenario were to happen, what will be the ultimate loss to the investor? The way the deal has been structured, enough cushion mitigants have been built so that there are no losses to the investors. But there is no guarantee. If tomorrow, let's say, a very bad COVID wave were to come, and there are economy level issues, defaults happening left and right, borrowers are not able to repay their loans. In such extreme scenarios, there can be losses to the investor, irrespective of how high the collateral has been kept. But it's very difficult to quantify such scenarios.
Understood. How is InCred trying? This is related to InCred. How is InCred trying to bring down NPAs? What are their recovery means?
So generally, all the NBFCs, they have an in-house collection team, and like InCred's management was also saying, they have focused a lot in developing their collection team. Unlike other NBFCs which kind of outsource the collection, InCred hasn't done that. They have an in-house collection team. They have a dedicated process when a loan becomes 0-day delinquent, 30-day delinquent, 90-day delinquent. The collection team takes efforts, does the planning accordingly, so that any customer who is not paying, they reach out to via telecalling, send legal notices, do physical collection also if required. And I'll say despite COVID wave, the company has managed to keep NPA levels below 4%, which is much better than the industry standard. So the collection efforts are actually kind of paying off.
Understood. The PAT has fallen since 2019. Is it because of provisioning? Guidance on quarters?
Yes, it is because of provisioning, because of COVID. The NPA numbers have increased across the board to a certain extent, and due to increased NPAs, entities have had to do provisioning on the restructured book, on the delinquent book, etc.
Understood. I have a question that if loan becomes NPA or bad debt for NBFC, then how is it secured to us?
So one thing is, like, if a loan is becoming NPA, the credit cost will be borne by the entity. Entity will replace that loan with a performing loan for our transaction, for our structure. So that hit is taken by the entity. Entity will do its own recovery efforts and try to recover money from the defaulting borrowers. But as far as our transaction is concerned, that NPA loan will be replaced with a performing loan.
Understood. Okay. This question is, I might take this question, or Anshul, you can elaborate. Can you please elaborate more about unsecured loan? What exactly are risk analytics and tech as explained by Bhupinder?
Sure. So unlike secured loans, wherein you underwrite both the borrower's repayment capability and or the underlying security, in case of unsecured loans, such decisioning at scale happens in an automated manner, wherein you typically go through the salary statement of the borrower, the bank statement, the past CIBIL score, credit history of the borrower. Define your tolerance limits. Define your policy that a borrower should have this much salary score, should have a overall leverage of let's say X times, the FOIR that we call in the industry, the fixed obligation to income ratio, can at max be, let's say, 30% or 40%. And you see in the past, in how many other liabilities the borrower has defaulted. This is Equifax data, CIBIL data, etc. So all these variables go into the algorithm, and then the system tells whether this borrower is worth onboarding or not. So, and a lot of fintech entities are now coming up with different parameters which they are adding to the algorithm. For example, if the app is their app is installed in your phone, the app will track the geolocation of you, like whether the location of your phone is same as the location of the company that you have mentioned in your application. So such checks and balances help to mitigate any fraud cases, any of those borrowers who do not have the intention to repay. They will also go through the contacts to see what kind of other contacts are there in your cell phone. So all this goes into the algorithm, and then a typical personal loan Nbfc does the credit decisioning, whether it's worth onboarding the borrower or not.
Understood.
Ajinkya, we also have this Slido link, so I think we can take that up.
Yes. So, folks, we are conducting a small quiz here just to understand, just to know that like people have understood, right? So people have understood what the asset is all about and what are the risks, especially, right? So the link is there. Okay. Can you, Indrit, can you paste the link in the chat for everyone to see and join?
Yes.
So this is a small quiz. That's just to, for you to make sure that you understood what are the risk involved, what is the asset about, who is issuing the asset, etc. Yes, here is the link. In the comments, you can see the link, right? We'll just wait for more folks to join and then start the. Indrit, can we know how many people have joined? 50. Okay, so we'll just wait for more folks to join. 18. Okay, should we start or should we wait for more folks to join? Some folks are still joining, so we'll wait. Yes, we have about 30 folks. Okay, people are still joining. Yes, you have to answer the question not in the Q&A section here, but in the link. So you have to click and join the Slido link if you're not sure yet. There is a Slido link in the message chat box. You can see this link. In the chat box, can you see the link? App.slido. Indrit, can you paste that link again? A couple of people can't see the link yet. I am pasting it again. Yes. Yes, the link is yes. Let's start. I think. Let's start the quiz. Okay, so this is the first question. InCred Jan'22. This asset is issued by which of the following Nbfc? Bajaj Finance, Ugro Capital, InCred Financial Services Limited. It's a pretty easy question. I hope nobody gets it wrong. Okay. Okay. I hope people who wrote Ugrome did it out of fun, but obviously the answer is incorrect. And if you're not sure, please reach out to our education team, right? And they will answer it for you. Right. So let's go on to the next question. Right. How many series are present in InCred Jan'22 assets? 7, 1, 3. Series are type of bonds that you can subscribe in the same IPO, right? Same public issue, right? So how many are there in this issue? Oh, so a lot of people have answered actually one. So there are 3 series. When I say series, it's like the tenure and amortization schedule might vary. So here are 3 series. One first series gives you complete capital after 1 year. Second series gives you complete capital after 2 years. And third series, there is amortization. So 50% of the capital will come after 1 year and 50% will come after 2 years. So if you have invested 20,000 in the third series, 10,000 will come after 1 year and 10,000 will come at the after 2 years. If you invested 20,000 in the first series, then you will get 20,000 after 1 year. If you invested 20,000 in the second series, you will get 20,000 after 2 years, right? So hope this is clear, right? And I am going to personally apply into amortization kind of series, that is the third series, right? So if you are not sure, probably that's the best option, right? So yeah, let's go to the next question. Which of the following is not a risk in InCred Jan 2022? Credit risk, fraud risk, hazard risk, liquidity risk. Okay, so just to be clear, the question was which of following is not a risk. So hazard risk is not obviously there, right? But there is credit risk, there is fraud risk, there is liquidity risk, right? If you're unsure about it, get in touch, understand the risk completely, right? Let's go on to the next question. The NBFC InCred specializes in which type of loans? Vehicle loans, home loans, or personal loan, education loan, and SME business loans? We spoke about this. Bhupi also answered a couple of questions around this. Okay, okay, this is great. I don't need to talk more about it. Let's go to the next question. InCred January 2022 is dash dash which type of bond? Senior secured bond, unsecured bond, or 81 bond? Okay, it is definitely not 81 bond. It is not also unsecured. This is senior secured bond, just to be clear. So a lot of people might confuse because 50% of the underlying loans are unsecured, but the bond is still secured. What it means is the InCred is guaranteeing that they will pay out after 2 years. If they are not able to, there is an underlying pool of loans. 50% of that loan is property loans and 50% are personal loans, right? But there is a dedicated pool of loans that investors have first and exclusive right over, right? For like, so whatever money comes from that pool of investors will flow to investors, and it is 20% over collateral. So in that sense, it is senior secured bond and not unsecured bond. And obviously 81 bonds are not meant for retail investors, right? So these are not 81 bonds. So this was the quiz. Thanks for people who joined in, right? So we'll get back to the question. So this was just as a refresher. Okay, there are winners. So Harry, congrats. Animesh should not be a winner. He's the part of the risk team, so he should answer this without even there is no timer. Congrats Christopher, congrats V, congrats Pradeep. Great job. So let's get back to the questions, right? We have about still 50 plus questions which needs to be answered. This 50% loans being unsecured increases the risk a little, right? Then why is interest rate lower? Anshul, can you answer this?
So the interest rate of any structure will be a function of both the things, the underlying collateral pool and the Nbfc, which is issuing the bond. So for example, if tomorrow Bajaj Finance were to issue a bond, which is backed by 100% unsecured loans, even though the underlying pool is completely unsecured, it's 100% unsecured loans. But because it's Bajaj Finance which is issuing the NCD, the NCD pricing might be 6.5% or 7%. So pricing of any secured bond should be seen in the context of how strong the Nbfc is, which means how strong is the equity position, what's the leverage, how diversified the lender base are, what's the portfolio performance, how the business is doing, and what's the underlying collateral.
Understood. What is the average credit score of the customers to whom these loans will be given by InCred?
So a lot of NBFCs which are doing PL underwriting, they don't look at the CIBIL score per se. Like Bhupinder also mentioned, they have their internal models, internal algorithms, which are a function of multiple things: salary statement, overall leverage of the borrower, fixed obligation to income ratio, uh, in which sector the borrower is employed, uh, is he from a metro, is he from a tier 2, tier 3 location, what kind of cell phone the borrower is using, uh, and a variety of other functions. And a lot of these NBFCs also lend to new to credit borrowers who may not have a CIBIL score to begin with. So CIBIL score is normally not looked at. So
Understood. And I will mention my personal experience, right? So before this, I was heading merchant lending business at MSWIFT, right? There we used to look at the actual loan history of individual loan rather than a score. We have rejected many cases where the CIBIL score was 750 plus and approved many where CIBIL score was 660, 650, right? So it the detailed policy, generally most of the lender customize that policy, and no lender today, a sophisticated lenders, actually lends using the CIBIL score. It's just a good indication for the investors, for the lenders, for you to see, but it actually like depends on like repayment history of every loan that you have taken. uh, Yes. So next question is, if the focus of InCred is on retail loans, why are they merging with KKR, which is highly structured wholesale loan book?
Sure. So Amit, even though it's being called a merger, technically it is still a merger. But if you look at the essence of the transaction, it's more like a equity infusion which is happening. Because the equity which is coming on InCred's balance sheet is more than the loan book which is coming. So as per the public document which is available, which InCred has shared with the exchange, etc., one can see that it's more of an infusion which is happening, though alongside that a small portion of wholesale book is also coming on InCred's balance sheet.
Understood.
And this wholesale loan book has been vetted by entity. All the loans have been performing in nature. And entity in the publicly available document has also mentioned that that book will eventually run down over time. They don't plan to grow on that wholesale book.
Understood. Uh, are these bonds convertible to equity in case of default?
Yes, in if the entity were to default, depending on how the bankruptcy proceedings play out, it's quite possible under the restructuring, under the insolvency proceedings, if lenders so desire, and if the administrator of the proceedings deems fit, a portion of the liabilities can potentially be converted into equity, but it depends on how the bankruptcy proceedings play out in the scenario that entity has defaulted. There is no guarantee that such a conversion can happen, but it may happen if all the lenders and administrator are deemed fit.
Understood. What are the major pressure or pain points in this issue that InCred and Wint majorly are cautious about, and how does that affect the repayment or the default risk?
So I think the major foreseeing risk for, at least for me, if I were to look at the issue, will be how the COVID situation pans out. Even though entity is well capitalized, it has 1,000 crore equity base to whether any small event or even medium sized event. But if tomorrow, like there were widespread defaults happening in the economy because of, let's say, a very extreme COVID wave, That can be a risk for the investors.
Understood. Do you think still it will pass on the over collateralized capital and wipe out the complete underlying collateral?
Looks unlikely. It will, like I said, will have to be a very black swan extreme kind of event. So yeah.
Understood. Who are InCred's peers? Could you name a couple of Nbfc which are similar in terms of probably rating or loan book size or asset, like the type of loans that they do?
Sure. So very good peer, I think, will be Navi Technology, the entity floated by Flipkart's ex-founder Sachin Bansal. That again is in A rating category, rated by CRISIL only, and has predominant one difference. However, there will be, while InCred has a around 40-50% secured book, Navi has roughly 80-85% unsecured book. So it's predominantly in the PL segment and has a small housing book, but that can be a good peer of InCred if we were to look at the PL segment.
Understood. How is the collection ratio of InCred for last Q3? And what is the outlook? How much percentage of the staff are working from office?
Q3 numbers are not in public domain. What we have are September numbers. And if you look at the NPA numbers, they have been below 4% as on September.
Understood. In case of NPA account, is there any selling off to asset restructuring companies? Are they selling off these portfolios?
Yes, typically NBFCs do sell out NPA portfolios to ARCs. Whether InCred is doing or not, we can check with the entity if they have done any transaction in recent past.
Understood. Yes, these are answered. What would be Windwell's role in recovering the amount should NBFC defaults?
So the primary responsibility will be of the trustee. But having said that, we mentioned this in our earlier webinar also, that we normally invest 2% of every issue that we list on the platform. By virtue of that, we are typically the largest investor or lender in any transaction. So we will be coordinating with the trustee, try to navigate like how to get the best possible outcome for us and our investors. If let's say bankruptcy proceedings were to happen, there is a scenario that we might have to sell the underlying security pool to a bank and Nbfc. We will try to reach out in the market to other banks and NBFCs and provide whatever support a trustee might need to ensure that maximum recovery happens for all the investors.
Anshul, the underwriting of this asset also considers only PD, or is it combination of PD and LGD?
No, when we underwrite the entity, we look at both the things.
Could you elaborate more what is PD and what is LGD for everyone else?
Yes. So whenever we are like investing in any transaction, what matters to us is if a default happens, what's the amount of money at risk, and to quantify, to calculate that number, that how much money I can lose, I need to look at two things. Firstly, what is the probability a default will happen, which means probability of default. Second is the loss given default. Okay, that default has happened. What will be my loss in the transaction? So if I multiply both these figures, probability of default and loss given default, I get to expected loss in the transaction. Now, the point I was making while answering one of the earlier questions was rating agencies in India, they only rate probability of default. They don't look at loss given default. That's why whether an entity does a senior secured bond which is backed by 1 times collateral, a senior secured bond which is backed by 2x collateral, or a senior unsecured bond, all three bonds get same rating by the rating agency, because they're only rating probability of default, not loss given default. While on the other hand, when we structure a transaction, we try to reduce loss given default as much as possible. And how we achieve that is by having a cushion in terms of the underlying collateral that we are taking. we typically have at least 15 to 20% extra collateral in the transactions that we list on the platform. Also, we prefer to list those transactions, structure those transactions where the underlying collateral is very strong. There are stringent criteria around what kind of collateral loans can come in our security cover. So that ways we try to mitigate loss given default so that the expected loss in the transaction is reduced.
In previous covered bond issues, Wint was cherry picking the loans in this pool. Is that the case in this issue too, or is the loan picking completely in Nbfc's scope? Has anything changed?
So nothing has changed as such. Even in the earlier transactions, the cherry picking used to happen by a certain criteria. Similarly, even for this transaction, a criteria has been hard coded, has been defined, and only those loans which meet the criteria become eligible to be part of security pool. Now, let's say there are 10 loans which are eligible. That discretion is on the entity, which of those 10 loans will become part of the security cover. But any loan which becomes part of the hypothecation of the security cover needs to meet all those criteria.
Understood. At what rate InCred has lent to its customers?
So typically, if you look at the NBFC sectors, NBFC market, PL underwriting happens in higher teens, let's say between 17% to 20%. School financing typically happens around 14 to 18%. And student financing normally happens at a slightly lower pricing because it's considered a good asset class, which is roughly around 12 to 15%.
Hey, Ram has this question in regards to benefits of Windwell on hosting this bond issue is not answered, especially when an investor could invest via other sources. Need to understand how much skin does Windwell has in this. So Ram, for every issue that we bring, we own 2% and hold till maturity. So this is a 125 crore issue, right? So we will own 2.5 crore, like subscribe to 2.5 crores and hold it till maturity. And for like how much we earn is like for every application we will make fees of about 0.7%, which is very low in this issue. Generally we make 1.5% per year. Some of the issues we have made that much, right? And that's the average range that we make. Some of the issue we make more than 1.7, some of the issue we may make less than 1.7, right? So we always, whatever we bring on the platform, we have 2.2% skin in the game. So there is another question, Anshul. If Nbfc default, how long does it take to get back the amount?
It's a good question. Let me answer the question in two parts. First, explain what's the process, and then I'll come to how much time it can take. So, in case if our Nbfc has defaulted, there are two scenarios which will play out. First is all the lenders will get together and RBI will admit the entity into IBC. IBC is insolvency and bankruptcy proceedings. During the initial 6 months, a moratorium is declared. The administrator, which is trying to revive the entity, tries to find out buyers in the market, tries to see if by restructuring the liabilities, the entity can be revived. Basically, all efforts are put to revive the entity. Let's say administrator has tried his best and a revival is not possible. Then proceedings move towards liquidation of the entity. In liquidation, the lenders, the senior secured lenders, they can make a claim over the underlying security, and money coming from that security will start flowing to those senior secured lenders. Once all the senior secured lenders are paid off, if there is money left over, it will go towards senior unsecured lenders. And still, if there is some money left over, it will go towards subordinate bond investors. So first priority is of senior secured lenders, second is of senior unsecured lenders, and last in the queue come the subordinate investors. That's why we say from a risk perspective, senior secured lenders have lowest risk. Senior unsecured lenders have higher risk, and subordinate bond investors have the highest risk. This end-to-end process, depending on how the bankruptcy proceedings play out, can take 6 months also, can take 12 months also, can take longer than that also. It depends like whether entity one is able to revive the entity. If not, then how long the underlying pool, what's the tenor of the underlying pool. In case of InCred, most of the loans have tenors of 18 to 36 months. So if such a liquidation scenario comes, one should expect around 18 to 36 months for the liquidation to happen. There is another scenario which is possible. Let's say the underlying security cover is performing well. Then the security cover can be sold to a bank which is there in the market. If such a bank is there who is willing to purchase the pool in one go, then the recovery can even happen in 6 to 9 months. One need not wait for entire security cover to run down to recover the money. The trustee will just sell the underlying security pool to the bank and pass on the proceeds to the investors.
Understood. The geotagging parameters or the personal technical data which InCred uses for risk analytics, won't that invite legal troubles for the NBFC and then indirectly to investors? In short, are those data acquisition and legal in India? These are completely ethical and legal. So when the borrower takes the loan, right, he has to agree to these conditions. Only then the loans are given, right? And even when the borrowers have given permission, there are certain set of rules that these entities have to follow to make sure that they're completely legal, and InCred follows that, right? So like this is not illegal or unethical in any sense, right? Okay, there is one question by Jaideep. In case of event of default for mandatory prepayment, majority shareholders consent is required. How will the consent of 4,000, 5,000 bondholders taken?
Sure. So Jaideep, in such a scenario, trustee will reach out to via email to all the bondholders, and e-voting will be done. So depending on how many bondholders do that voting, and depending on the results of the voting, the decision will be taken. There has been precedence in the market in past also, and such voting exercises have been done. Now, thankfully, with the advent of technology, it's not that difficult a task. Earlier, when such a thing used to happen by postal ballots, etc., it was still tricky. But most of the proceedings happen now online, so it's quite manageable.
How is Windwell making sure that different retail investors get to apply for this issue? Means not existing investor has more preference than any new investors. So as a platform, we have always committed that we will give preference to our existing investors because we ask them to diversify. So if somebody has invested in one issue, we want to help them more to apply for more issues and diversify. So that will also apply once you become existing investor. How we are solving is by bringing more asset sizes, right? Just making sure that next set of assets don't get over in hours, like that happened with a couple of last assets, right? If you see our total AUM today, like the amount invested through platform is 150 crore, but this issue we are bringing 125 crore. It is pretty big, and we hope that it doesn't get over in hours, right? But however said and done, we will always prefer existing investors, right? And because they've trusted us first, right? And second, diversification is very important. If you're not doing diversification, just investing in one asset is not at all a right strategy. In case of default by entity, how will Windwell help in ensuring that we as investors get best assistance?
So I think we kind of covered this query earlier also, but just to repeat, typically in all the issues, we are the largest investor in the issue because we invest 2% of the issue from our balance sheet. So even though legally the responsibility is of the trustee, we would be very much a part of the proceedings as the biggest investor in the issue. try to maximize whatever recovery can happen for the investors in case such a remote scenario were to take place.
Understood. Pawan has asked this question: how does Windwell? So we have covered most of the questions related to InCred. So we'll answer the question related to Windwell platform. How Windwell does get benefit by this? So I mentioned we are getting 0.7%. We are not actually getting 0.7%. In this issue, we are getting, I guess, 0.55%. So little more than half a percent, right? So compared to the amount that is invested. How can we know that particular scheme here is not going good? So once you invest, we send out monthly reports, right? And you can see those reports on your dashboard, right? So you would know how are the numbers changing, how many loans were prepaid, were replaced, or are not healthy, and how is that trend coming along. You will be able to clearly see month on month, right? Okay. Yes, this is answered. Allotment कैसी होगी? So this is not a equity IPO where there is a lottery system as such. This is a first come first serve allotment. So if you apply and the issue is open, you will get the allotment. And once all the allotment is done, the issue will be closed. Is this right, Anshul?
Yes. So first come first serve happens on a daily basis. But let's say in one day only, we get 200 crores worth of bid, while the issue size was 150 CR. Then on a pro rata basis, allocation will happen. So first come first serve isn't counted on a hourly basis or a minute by minute basis, but on a daily basis, which means, let's say in this issue, in first day we get 100 crore bidding from our investors. So all those investors will definitely get their units. Now second day, let's say again we get 100 crores worth of bid, while the maximum remaining allotment can be done is of 50 CR. So for investors who are bidding on day second, there a pro rata system will be applicable.
Understood. Okay. There is one really interesting question from Shashank, a generic question if you choose to answer. Equity market expects up and down, but the current bull run continues, save for little intermittent downs. That being the case, is it wise to still sit in cash waiting for big correction or just to invest at current levels? So Shashank, probably if you find an answer from someone, give that answer to me. It will be very relevant for me too. And second, whoever is giving answer with very confidence, make sure that person himself is following this strategy. It's very easy to give answers when where you don't have skin in the game, right? So cool. Will you be timing your future offers with maturity dates of existing and open issues so that customers don't lose by staying in negative carry? Yes, we have such plans. As soon as the assets are matured, we will try to give preference for the investors who have invested in that asset. So their money gets reinvested fastly. So we have such plans, and stay tuned for it when the assets come on the platform, when the maturity date comes. Can you please share all these questions asked in the Zoom chat with answers for reference? Thanks. So AG, I mean, the question we have answered live, you can obviously see through on this webinar will be uploaded on YouTube, so you can see it. For chat, we will provide you, just ping us on the WhatsApp, and one of the team member will send you this question and answer. Yes. How to avoid over diversification? How many assets max should we have on Windwell? This is a question by Yatish. Minimum 10 till 10, like till you get into 10 assets, don't think about it. 20 is an ideal number, I would say, right? So there is no clear answer, but minimum 10 is very clear in my mind. Yes, it's clear things. What is the hedging against these bonds? There's a question by Ritik. Anshul, you want to take it?
So there is no hedging as such which one can do. I mean, the residual credit risk lies with the investor. Even though all the risk mitigants have been put in place, some amount of risk is still there in the transaction, and that risk continues to be with the investor. There is no insurance or guarantee which one can take from a bank or any other market player to hedge against the risk.
Understood. In like, we are not doing hedging, we are doing a lot of mitigation, and we spoke about it. How are we mitigating liquidity risk? How are we mitigating fraud risk? How are we mitigating credit risk? But yeah, so mitigation is happening, not hedging. All right. So there is a question from Anand. Currently, equity in InCred is about 1,000 crore. Vaibhav said that this is not a liquid cash. 1,000 crore refers to shareholder investment net worth in the company. InCred can spend this money for salary, and when this money is spent, will InCred's net worth decrease from 1,000 crore?
So InCred's net worth will decrease if entity starts making losses. Let's say whatever salary and operating expenses are there. Typically for these asset classes, it ranges in the figure of 4 to 6%. That's the operational expense which is there. Add to it cost of financing, which is, let's say, 9.5 to 10%. So these two put together comes to around 14 to 15%, while deployment is happening at the rate of 18, 19, 20%. So whatever is left over is for any credit losses that can come from the portfolio, and balance is the profit. So as long as entity is making profit, the net worth of the entity will only increase. Only in the scenario that entity starts making losses, the net worth will start going down. So I think the correct framework to analyze this is whether an entity is profit making or loss making, not how much entity is spending on the salaries or operational expenses, etc. If after spending all those things, whether entity is able to generate profit or not. If losses start happening, then the net worth of the entity will start going down.
Understood. With respect to first question related to restructuring, what is the restructuring pool as percentage of the overall book? Considering 80% of the restructure pool goes delinquent, it would impact the NPA, and as and when the restructure pool is present. Anshul, can you answer this?
Sure. So if we, I think Bhupi also mentioned, touched on this. So the restructured book is in mid single digit, and most of the restructuring has happened in the secured segment only. So even if one were to assume that, let's say 50% of the restructured book will be written off, and I'm using 50% because Vivek mentioned that in a secured segment, at least 50% recovery happens. So that will add, that will come to 2.5%. So that's the incremental risk one can assume in the calculations.
Understood. How are you going to ensure that customers will get stated returns?
There is no guarantee as such, like I mentioned, and Ajinkya also spoke about this. This is not a risk-free investment. Don't think the money is guaranteed here. It's not a replacement for FD. There are risks, there are mitigants, and in spite of mitigants, there might be some residual risk. So don't assume that it's a guaranteed return that you are getting. It's again not a replacement for FD.
Understood. This is a question from Piyush. I have already subscribed 5% of my portfolio is in previous issue, but I wish to continue to participate on this one as well. Do you think another 2% is okay? Keeping in mind diversification that you mentioned, or should I keep it even lower? So Piyush, that's a very good question. Don't cross 10%, right? And as more assets come, you might explore actually withdrawing from that 5% you invested in one asset, and lowering that exposure and increasing that exposure in other assets. So like, you can increase the exposure, but also start diversifying. You can as well start taking some exit from in the one asset where you invested 5% and diversify it well, right? So I hope this answered the question. Okay, okay, Anuj is answering this. What is the customer segment you are targeting? Urban, rural? How do you reach your customers? So if that means you and investors, our investor base is still pretty urban, still coming from towns, tier 2, tier 3 towns. How do we reach? It's completely digital. Most of the work is happening through referrals, LinkedIn, etc. Right? Okay. If the question was for InCred, then they have a lot of partnerships, their own branches, and a lot of digital ads are run. Okay, we can start. So some of the questions were pending. Indri, do we have these questions handy? 5-6 questions were pending.
I think one was on the taxation part, how the taxation of the instrument will work.
Could you answer that, Anshul?
Sure. So the taxation here will be like as per your income tax slab rate, which means if you're in the 20% tax slab, then the taxation on the interest income will be 20%. These are listed bonds, so there won't be any TDS deduction. While filing your income tax return, you'll need to declare the whatever interest income you have earned and pay tax accordingly.
Understood. Yes. Any other question? Pranav, Indri, do you have any questions handy?
One more. I think people are putting in their question over here itself. Right?
Is it possible to share recording of the previous session? Yes, Brajendra, the recording will be shared. It will be put on YouTube, so you can go through it, and with the time stamps also, so that you can jump to the thing that you want to discuss about. So since there are like less number of people, so we can actually take these questions audio or video. So thanks for joining in again. If there are any questions, please unmute yourself and like through the question we can answer it live, right? Yes, Anshul, so one of the question was, which I can answer, is like people wanted to understand this, how is this compared to 12% club or Bharat Pay offering 13.5% NCD? Can you answer that?
Right. So I think there are two key differences here. One is when you are doing P2P lending, you are taking direct exposure on the end pool of borrowers. For example, let's compare that to a bond wherein the primary obligation is of an institution. In our example, the primary obligation is of InCred. No matter whether their end borrowers are paying or not, InCred, if required from the equity, needs to repay the lenders in full. While in case of P2P lending, there is no such institution which is guaranteeing the repayment. So that's one key difference and a very important one, because InCred, for example, it's a well-capitalized entity with low leverage, equity investors, etc. So that entity is obligated to repay back the investors the money, irrespective of the performance of their underlying portfolio. But in case of P2P, like I said, there is no such institution which has this obligation. Second is in P2P lending, there is no credit enhancement which is there. For example, in case of InCred bond, for a 100 rupee investment, we have 120 rupees of collateral. In case of P2P lending, there is no credit enhancement, credit cushion which is there. If you have lent 100 rupees, the underlying loan itself is also of 100 rupees. So because of these two things, the risks in P2P tend to be much higher compared to a senior secured bond issued by a well-rated, well-capitalized entity.
Understood.
So while looking at, let's say, 11%, 12%, 13% returns, one needs to take this judgmental call whether extra 1%, 2%, 3% justifies the incremental risk which is there in the transaction or not.
Understood. Anshul, another question was that some IPO has come, that IPO of Gani app. How do you look at it? And it gives higher return. Right? So one of the question.
Right. So I think that's again a senior secured bond issued by another entity. So I think I'll request our investors to go through the rating rationale of that issue, another live issue which is there. There are 2-3 concerning things which rating agency has highlighted. Entity also got downgraded just last month. So entity was into a particular business segment which did not perform well. So entity is running down that business and now starting a new business. Whenever you are funding such an entity which is starting something new, there are risks which are associated, because it's an uncharted territory for the business. Business may do well, may not do well. It's something new that business is trying. Secondly, the fact that an entity has been downgraded as recent as last month is definitely a cause of worry. At least in the eyes of rating agency, there is something not that great with the entity which has happened, because of which the entity has been downgraded. So that rating rationale, it's a good crisp document which is there. Maybe I'll just paste the link of the document on our webinar also. So will be great for our investors to go through that before making the investment.
Would you personally invest, because that all said and done, would you personally invest in that issue?
No, I have given it a skip. In fact, we had the option to bring that entity on our platform. We have taken a call not to list as of now. We'll wait for and monitor to see how the entity starts performing in the new business segment that it has ventured into. Let the entity have some vintage there. Maybe if things go well, then we can look to invest.
Understood. Yes. Next question is why Windwell? What does Windwell stand for? So Windwell, the origin of the word is actually WINDT, which means savings in Irish. So we're just looking for a short name. So we really like the name, and that's why we went ahead with the name. Now, next question is, what is, like, I want to know advantage of Windwell over Golden Pie. Anshul, can you answer this?
So at Wint, we like to curate our own bonds. We don't list any bond which is there in the market, which is unlike other portals which are there, which act more like a distributor. They list any and every public issue or any and every bond which is there in the market. While we like to carefully vet what kind of issues we want to list on the platform, issues where we feel comfortable investing our money only those kind of issues we'll list. Secondly, we only list senior secured bonds. We don't list any senior unsecured bond, any subordinate bond, any perpetual bond. We don't think the risk in those structures are for retail investors. Retail investors should stick to senior secured bonds only, that too issued by good reputed capitalized entities. Thirdly, we are not listing any secondary market transactions, which means bonds which have been issued in the past, someone is looking to sell it down. We don't do such listings.
Understood.
And lastly, like I said, in all the transactions that we list, we have a skin in the game, which I don't think other platforms in the market are doing.
There is a question, investment should be done via Windwell or let's say ICICI Direct. You could do investment from both sides. There is perfectly fine. If you invest through Windwell, you will get monthly reports and have access to information. And obviously risk education, and you will have access to upcoming issues also on priority. With the US bond market yield on the increase, how debt funds in India will perform, like Bharat bond or secured bonds?
So not per se directly correlated with the US yields. I think in an indirect way, there is some correlation. If globally the interest rates are moving upwards, it's quite fair to assume that even in India, the rates will start moving up. And we are already noticing early signs of that. I mean, quite recently, a couple of large banks increased their FD rates. And there are enough visible signs out there that a year down the line, the interest rates might be higher in the economy. Now, coming to debt mutual funds, whenever interest rates start moving up, we should be slightly cautious, because NAV of debt mutual funds is inversely correlated with the interest rate movement. If you had seen the debt mutual fund performance over past 2-3 years, some of the mutual funds have given like decent returns. That is primarily happened because over past 2-3 years, interest rates in the economy moved downwards. And like I said, NAV is inversely correlated with the interest rate movement. So if interest rate is going down, NAVs of mutual funds will start increasing. Now, since the cycle has reversed, and the interest rates will start rising from here onwards, the NAVs of debt mutual funds will start underperforming. So that's why, as investors, one can avoid debt mutual funds where the underlying duration is long. Because another factor, another parameter which affects the movement of NAV is what's the duration of the mutual fund. By duration, I mean what kind of bonds the mutual fund is investing in, whether those are long tenor bonds or short tenor bonds. Longer the tenor of these bonds, more will be the impact on the NAV. So that's why a lot of these long duration mutual funds, which are investing in government securities, which tend to be of 5 years, 10 years, will underperform more compared to, let's say, liquid fund, where the underlying tenors are between 3 months to 6 months. So if you are holding any debt mutual fund, which is investing in long tenor assets, I think it might be recommended to shift to those debt mutual funds where the underlying tenors are shorter.
Wonderful. How can we invest more than 2 lakhs? Anshul, do you know the answer for this, or we can ask Indra to answer this?
I think investors can submit multiple applications up till 10 lakhs. So let's say someone wants to invest 5 lakh. You'll need to submit 3 applications, 2 worth 2 lakhs each, and the third one worth 1 lakh rupee. So by submitting multiple applications, you can invest up to 10 lakhs.
Understood. Makes sense. Okay, those were the questions that we weren't able to answer before it got snapped down by Zoom. Okay, people who have joined this call, any questions that are yet not answered, please feel free to ask. Since there are a very less number of people here, we can actually take the questions directly through audio. Yes.
I think Pradeep has a question.
Okay. Pradeep, yeah, Pradeep, can you just unmute yourself and ask the question? Pradeep, can you hear me?
Yeah, can you hear me?
Yes, yes.
Yeah. What is the safety of this this thing you have given? What is the safety on the investment which you are assuring us?
So, Pradeep, we are not assuring anything, right? We have spoken about the risk in detail, right? There are some risk involved. These are high risk instruments. The risk is mitigated, but there is a certain risk involved. If you are saying assurance or guaranteed, and if you like by that, if you are comparing it with the risk profile of FDs are much safer, right? These are backed by up to 5 lakhs for retail investors. These are backed by governments. Right? So the risks are well mitigated, right? And we have skin in the game, right? But there are still risk involved.
Hello?
Is
Yeah.
what I wanted to say.
Heli.
Yes. Pradeep, does that answer the question? Okay, I guess he has dropped off. Any other questions, folks? Great. So we'll wrap this up. Thanks for joining in. And if there are any questions pending, if you come across some questions later, feel free to reach out to us. And sorry for the technological abrupt end that happened to the webinar. But hope we have answered all the questions. See you see you soon in next webinar pretty soon with the next asset. Thank you, everyone.
Thank you.